Hello, this is Bubba Bashaw with Lionshare Training. Lionshare Training is an education company. Generally, I teach realtors and loan officers about the different lending programs like FHA, VA, USDA. But today, I want to put together a program just for you. So many consumers have no idea what it takes to qualify for a home loan. And unfortunately, if you called 5 lenders, you'd get 5 different stories. So as a person who teaches the guidelines, I wanted to bring to you the actual guidelines so when you go shopping for a home, you'll know what to take as a true answer to your question. Now, I want to preface this by saying Lionshare Training is not a lender. We're not a lender, so I can't offer you a loan. We cannot take your loan application. That's not what we do. I teach lenders and I teach realtors. And just for this day, am I teaching you what to look for when buying a home. So today we're going to really take a look at FHA. But I will tell you all lenders are not equal. And the reason why is FHA is offered by your local bank, it's offered by your credit union, it's offered by mortgage bankers, and it's offered by mortgage brokers. And the one you choose will dictate the interest rate and whether or not you get approved. And here's what I mean by that. If you go to your local bank, big Chase Bank, for example, and they're a great bank, but they're regulated by the FDIC, Federal Depositors Insurance Corporation. And the FDIC is in place to make sure that people who put money in the bank, that their money's safe. So they set rules and guidelines that the bank has to follow. And it has to do with credit scores, minimum credit scores. So FHA, and you're going to want to write this down, FHA goes down to a 500 credit score. So does VA. Most people don't know that because you call a lender and they say, oh, our minimum credit score is 620. Our minimum score is 580. Our minimum score is 680. The minimum credit score for FHA is 500, period. You can look it up. Google it. Google FHA minimum credit score, HUD, H-U-D. It'll tell you 500. So you're going, why do they tell me different? Well, because the bank is regulated by the FDIC. And the FDIC says we can't loan to anybody under a 620 score. So even though they offer FHA, and even though FHA would approve you at a 500, they won't. Now here's a real problem. You go to the bank, you apply for an FHA loan with a 596 score, they turn you down, and you think FHA didn't approve you. That's not true. You didn't get approved through FHA through the bank because of the FDIC overlay. Same with credit unions. So choosing the right lender is going to make a significant difference. Now, when it comes to interest rate, listen closely. The interest rate depends on how many people are in the chain before it gets to you. So if you have a branch manager and a regional manager and a state manager, and then you've got the loan officer, they're paying everybody in the ladder. You want to go directly to a mortgage broker that is going to take your loan application and send it directly to the investor that is going to buy your loan. You don't need anybody in the middle. So finding the right mortgage broker is going to be very important, whatever state you're in. So with that being said, I want to tell you all lenders, regardless of the loan program, are looking for 3 things. The first thing they're looking for is your ability to repay. And that is simply how much money you make. Now there's 2 kinds of employment. You either are employed, meaning you get a pay stub and a W-2, or you're self-employed, meaning that you're the big man. You're in charge of running your own business, and they're handled completely different. So if you are self-employed, you're going to have to be able to prove that you have been self-employed for 2 years. And they're going to take an average of 2 years tax returns, which brings up another interesting topic. All government lending requires tax returns for proof of income. So if you haven't filed your tax returns or you write off everything, don't try and get a government loan. It ain't going to work. So you have to have good credit, decent credit, and you have to be able to prove your income. And then the third thing you're going to look at is the collateral. That is the house, especially FHA. You know, FHA started after the Great Depression in the 30s. And the reason that they started was to help rebuild America. Everybody had gone into wartime. They were building tanks and the women were making camouflage and all the factories turned into wartime effort. And after the war, everybody was unemployed and it caused a Great Depression. So the government decided we need to figure out how to put people back to work. So they started the FHA, Federal Housing Administration, because they knew if they built a bunch of houses that allowed people to get in with less money down, they'd need more roofing and more carpet and more walls, and everybody would go back to work. And it worked. and it did work. And the FHA still exists today. And it's a great loan program for a person who wants to purchase a home. And it's not just for first-time home buyers. So FHA is more lenient because it allows lower credit scores. It allows a higher debt-to-income ratio, which we'll talk about in a little while. But it's a great loan program. The downside to FHA, I have to tell you up front, is with FHA, you have to have mortgage insurance. Mortgage insurance covers a loss in case your house goes to foreclosure. So it's insurance that says if this house goes to foreclosure, the insurance is going to pay the loss after the home's been sold. And after 2010, I believe, under Obama, they changed the rule. In the old days, once your home got to at least have 20% equity in it, you could get rid of the mortgage insurance. They changed that rule and you can never get rid of it anymore. So the way you get rid of mortgage insurance on an FHA loan is to refinance into another loan. So don't let that bother you. I just wanted to mention that up front. So once again, they're looking at three things: your ability to pay, which is your pay stubs, or your tax returns, whether you're self-employed or W-2. They're going to look at the collateral, that is the house. Is it safe? Does it meet all the safety standards? Is it normal for the neighborhood it's in? And is the price right? And then the last thing they're going to look at is your willingness to repay, your credit. So as I mentioned, FHA is very good. They offer all the way down to a 500 credit score. But I'm going to tell you right now, from a 579 and under, you're going to have 10% down. If your credit score is 580 and higher, you only need 3.5% down. But the closer you get to that 500, the harder it is to get loan approval, because they're looking at that point for compensating factors. For example, I know of a person who recently closed and funded a loan, and the borrower had a 504 credit score. Their child got sick, their credit got tanked, they had a big expensive home, they sold their home, they had about $200,000 equity in it, and they bought a house for about half the price, and they had tons of money in the bank, and the only thing that was affecting was their credit score. And from FHA's standpoint, that was a make sense loan, and those people got a home. So don't let credit score make you believe that you can't get a home. But on the other hand, if you've got a credit score below a 550 and you've got no money, you're not getting a home. It ain't going to happen. You can't have both, bad credit and no money. You got to have one or the other. So in that case, keep renting, save your money, or look into credit repair. You can go to a great site called www.sterling, STERLING, creditgroup.net/loan Ranger, LOANRANGER. They work to get the negative items removed from your credit report, and they do a tremendous job. So that's if you've got the lower credit scores. All right, so let's go back and we're going to start at the ability to repay. If you're a W-2 employee, the guidelines say that you have to be employed for 2 years, or let's say you just graduated from college, your college transcript, and you have to have been on your job 6 months. If you just had a baby and you've been out of work for 1.5 years and you've been on your job now for 6 months, all they're going to do is say, okay, let's find 2 years of employment from the past. All you have to do is document 2 years of employment, and it does not have to be continuous. Although gaps in employment in excess of 90 days do have to be explained. But that doesn't mean you can't get a loan. You can still get a loan. The other thing is for stability of income. They don't want people who've had 4 or 5 jobs in the last 2 years. You've got to have some stability. So unless you were in the oil field business and you went from Halliburton to another one, and it's all in the same field, and every time you had an increase in pay. If it's understandable, yes. If you went from working at Domino's Pizza and then you went to driving for Uber and now you've gone to do something, you need stability or they're not going to approve your loan. So let's be realistic. But here's the thing. There's a lot of people who rent right now that should own a home, and they don't because they're afraid to. I hope you're watching this video because you should be a homeowner, and it doesn't take much cash, and we're going to talk about that in a minute too. All right, so ability to repay. W-2, they're going to take your gross earnings, and 50% roughly you can spend. So let's say you make $4,000 a month. That means $2,000 a month has to cover your house payment, taxes and insurance, and the minimum payments in your credit report. Hear me clearly. The minimum payments. So I'll tell that to people and they go, oh, well, I owe about 22,000 credit cards. Okay, I don't care what you owe. Minimum payments. That's it. So if you have $300 to credit cards plus a $300 car payment, that's $600. Plus your house payment, principal and interest, plus taxes and insurance. As long as that is 50% of your gross income, you're in good shape. Now, here's a little trick. Depending on the lender you go to, if you go to a broker, you're going to be better off, because I have seen loans approved under FHA all the way up to 65% debt ratio. If you went Fannie Mae or Freddie Mac, the limit is 50 and it's hard and fast. I mean, it's got to be 49.99999. You can't go to 50.00001. It will get turned down. But with FHA, you can. FHA allows higher debt to income ratios. Okay, so that's an employed person. You got to have stability. You got to be 6 months on the job. You have to have a 2-year work history unless you're a student, and then a transcript works, right? You follow me? Okay, now if you are self-employed, they want to see that you're self-employed in the same field for 2 years and your tax returns. So a lot of times people will say, oh, well, we take all the write-offs we can. Okay, well, that's great until you're ready to buy a house. Because the government says, well, you gave us these tax returns telling us your income, and now you're going to tell us that really wasn't my income? So if you take a lot of deductions, you may want to consider looking at a different type of loan program, like a bank statement loan program, where the tax returns are never even looked at. The other thing, if you haven't filed your tax return, you can't get a government loan. You have to be able to have tax returns to get a government loan. So if you're self-employed, they're going to look at the last 2 years. They're going to average the adjusted gross income. So go back and look at your tax returns, look at your gross income, then you took out your expenses, then you get your adjusted gross income that you pay tax on. That's what they're going to use, because that's what you told the government you make, and they're going to believe you. So you can't unspread the butter. Oh, maybe I'll go file an amended return. That's the fastest way to get audited. Don't do that. Look at a bank statement loan if the tax returns don't work. And often they don't, especially if you're self-employed. Self-employed people take every imaginable deduction under the sun, as they should. So don't ever overpay your taxes just to qualify for a home loan. Get a bank statement loan instead. In Lionshare training, we can give you a referral to a lender. If you need us, look us up. We'll help you out. So don't let that worry you. All right, so the first thing was ability to pay. The second thing is a collateral. They want to make sure the house is safe. So if you think you're going to buy an igloo in a neighborhood with all regular neighborhood homes, they're not going to approve it. The house doesn't fit the neighborhood. So you have to buy a regular house. Sometimes people get this crazy idea, oh, we're first-time home buyers. We'd really like to get 4 acres and put a log home on it. No, it ain't going to happen. So if you're rich and you got a bunch of money, you want to go pay cash for land and put a log home, then do that. But your first home, no, be reasonable. They're not going to approve it. So they want to make sure that the house fits a collateral. And here's what they do. They're going to look at your house you're interested in, and it has to be the approximate same age, size, and quality of other homes in the area. So simple. And then they're going to order an appraisal. And the appraisal, they're going to say, what did all these homes sell for recently, like the last 6 months? And then they're going to determine what the value of this house is. And with FHA, they will lend based on the appraised value or the sales price. And there's a little trick in there I'm going to tell you in a minute. So stay tuned for that as it comes to cash out of pocket. I'm going to tell you a little trick. All right, so that's a collateral. And now, willingness to repay. Your willingness to repay is your credit report. So for a FHA loan, they want you to have had 3 accounts that have been in an existence in the credit report, and that you do not have any missed mortgage payments or rent. Now, here's the little trick. Are you ready? If you pay your rent to an individual and you pay him in cash, it doesn't work. Your rent has to be verified for FHA the last 12 months. So I heard of this guy. He said, oh yeah, we've got all our check stubs. Well, then we started the loan. Of course, he didn't have any check stubs. He had a coupon from Western Union, and then we got down to we're missing a few months. And he goes, oh yeah, my landlord lives down the street and he was out of town. So I fed his horses and traded him 3 bales of hay. That does not work for FHA. So if you pay an individual for your rent, here's a trick. Go to rentalkarma.com. rentalkarma.com. They're going to charge you a fee, and they're going to ask for a copy of your lease, and then they're going to call the landlord and verify it, and they're going to put it in your credit report. And you know what happens? You've satisfied the requirement on your landlord. The other thing is going to make your credit score go up. So rentalkarma.com. This is not, they don't pay me. That was not a paid endorsement. If it doesn't work, don't blame me, but I know a lot of people who do it. So rentalkarma.com is a great way to get rent added to your credit report if you don't have 12 months canceled checks or you can't use bank statements to prove you've paid. Now, if you rent from an apartment complex or a legitimate company, you can do a verification of rent and they'll verify it that way. But if you're paying Mabel, who's owned the house for 73 years, and you just pay her rent, they're not going to take her word for it. That's like a letter from mom. My son is a very good boy. They're not going to accept that. You actually have to have verified verification of rent. That is in the credit report or from a legitimate company. Okay? Now, let's talk about what it takes to really purchase a home. If you're going to buy a house, and let's say you have a 593 credit score, then with FHA, you could get a 96.5% loan, meaning you need 3.5% down. So for easy numbers, let's say you're going to buy a $200,000 house, 3.5% is $7,000. Woo! Anybody can find $7,000, right? Save it up. The money can come from your own funds. It can be a gift from a family member. It can be out of your 401k, right? So there's a lot of ways to get it together. But you're going, Bubba, that's not all there is. That's right, there's not. There is more. You have closing costs. You have to pay for the title and the appraisal, and you have to pay for underwriting. You have to pay the processing fee, and all that stuff adds up. So let's say a $200,000 house, $7,000 is your down payment, the 3.5%, and then you've got another $6,000 of other closing costs, like you'll learn about this. It's called prepaids. So you have to set up an escrow account for your taxes and your insurance. You have to pay a year of insurance in advance, and you have to set up an escrow account, excuse me, so that when taxes and insurance come due at the end of the year, the lender has that money to pay them on your behalf. That's called an escrow account. And you have to escrow. You got to with FHA. So the question is, well, that means I need like $11,000 or more, $12,000, maybe even $13,000. That's right. But $7,000 has to come from you. The rest of it can come from the seller. Now follow me on this. You find a house that's listed for $225,000 and you negotiate and you wrangle like an alligator and you get them down to $200,000, right? So you're going to need 7% down or $7,000 down, 3.5%. But then you've got another $6,000 in closing costs. You're like, well, we've only got $8,000 in the bank. What are we going to do? Well, you could let the seller pay those. So you've already agreed on a sales price of $200,000. Write the contract for $206,000 and have them contribute $6,000 to your closing costs. They still get the same $200,000 they agreed to. But now you take $7,000 from your account. They give you the other $6,000, which is a $13,000 down. You're done. So you can buy a house for $7,000. It's so easy. And a lot of people don't know that. And unfortunately, a lot of realtors don't know to tell you that. So you got to be faster than the dog that's chasing you in this game, because you're going to get bad information from realtors. You're going to get bad information from lenders. You have to be educated. And that's what I'm here to do with you today so that you can buy the home you want that makes sense. So I hope that was helpful. Buying a home is the American dream. I remember when I was a little kid, unfortunately, and I'll tell you this isn't a Joe Biden story. When I was a little kid, my dad died when I was 5. And us having a home meant the world. And you can think of how many American families would be stronger because they owned a home. If you have kids, give them a home. Don't pay somebody else's mortgage. When you pay rent, you're paying somebody else's mortgage. You can own your own home. And Lionshare Training is here to help you. If you have any questions, you can send us an email. I'll give you my email address. It's bubba@Bashaw.com. BUBBA at BUBBA Now, again, I'm not a lender. I can't offer you a loan, but I can direct you to someone or maybe answer a question for you that a lender that you can't get the answer to otherwise. So I wish you the absolute best. I wish you would participate in the American dream. It makes America a better place and families stronger. God bless you.